Okay, so welcome back. This is part 2 of the How to Grow Your Business training course. So this is where we get into the guts of it. We've been through all the concepts now, so we're going to start talking about the processes and the actual what you need to be doing on a regular basis to ensure you have control. The 3 elements of control are the main focus of the remainder of this course. Part 2 focuses on performance evaluation and economic viability, and then part 3 will be mostly around compliance. So let's get started with performance evaluation. So now there are many ways to evaluate performance, but there's only one, which we're going to get to shortly, that will give you flawless reliability, which is the phrase we use to describe it because it is flawlessly reliable. So different types of performance evaluation. You've got sales reporting, labor analysis, KPI reporting, scorecards, stock counting, margin analysis. You know, these are all perfectly valid and valuable ways to evaluate performance and to make sure you've got things where you need them to be. However, they're all individual, they're all bitty, they're all granular. No one of these gives you what we need from a performance evaluation point of view. So what we're really talking about when we talk about performance evaluation is management accounts. What I'm talking about is specifically management accounts based on the accounting concepts we've talked about and comparative reporting. Because ultimately, without those two things, they're not management accounts. I've seen all kinds of things that people class as management accounts, and I'll give you some examples shortly. But proper management accounts are, they need to be done in a certain way in order to give you the flawless reliability that I'm talking about. So first off, let's just look at management accounts. So there's your profit and loss, there's your balance sheet, and there's your cash flow statement. They are the 3 statements or documents, whatever you want to call them, that you need to have in a set of management accounts. You can have other things as well as these, but this is the bare minimum for it to be classed as a set of management accounts. And this is what I was on about earlier. I've seen like a list of, month by month P&Ls. I've seen sales reports. I've seen all kinds of things that people tell me are management accounts. These 3 elements need to be in your management accounts or they're just not management accounts. I'll explain why. So you remember the accounting equation, the first of the accounting concepts we talked about earlier, which was assets minus liabilities equals equity or capital, however you want to, class it. So the balance sheet is arguably the most important of these 3 documents because it's the one that anchors everything. Ultimately, this proves the accounting equation has been adhered to. So assets, you've got fixed assets and current assets. And then there's your liabilities, current liabilities and long-term liabilities. So if you add them up and deduct them from that, you get 52,387. That is assets minus liabilities, 52,387. Equity, 52,387. So we've just proved the accounting equation has been adhered to in this business. Assets minus liabilities equals equity. So what that means is there's no way for anything to be wrong. From a numerical point of view, nothing can be wrong. Things could be put in the wrong category, or they could have been entered wrong in the first place. But that's where the 4 points of control come in. They will verify everything for you. The point at this stage is that the balance sheet proves that all your assets minus all your liabilities equals your equity, which is great. But I just said this, that the balance sheet anchors the other 2. So what do I mean by that? Well, 16,543 is the current year profit. So if you look at the management accounts, profit is 16,543. So the first thing you need to bear in mind is if this was anything other than 16,543, then this wouldn't agree. So that 52,387 is £100 of share capital plus the current year profit plus the retained earnings, which is the profit from previous years, equals 52,387. So if that number was anything other than 16,543, then this wouldn't agree with this and the accounting equation would fail. So that is what I mean by anchoring the profit and loss. By the same token, if any of these numbers in here were changed, then that would no longer equal 16,543. Now, I will concede that if you took £2,000 from here and put it here, that would still equal 16,543. So it doesn't mean that every number in there is absolutely 100% correct. But we will look at that later, the way that we ensure that that is the case. But all I'm saying is at this stage, that number doesn't prove that. But what it does prove is that every transaction has been picked up somewhere. So that's your starting point. So then that's the profit and loss in the balance sheet. So let's look at the cash flow statement. So cash flow statement has a closing balance of 42,887. And again, if you go to your current assets, banking cash equivalents, 42,887. So the same principle applies here. If any of these numbers were wrong, this would not agree to 42,887. And if this number was anything other than 42,887, then your net assets would not be 52,387, because this number here is all your assets minus all your liabilities. So we've proved both sides of the accounting equation. And again, these are not at this stage proven, but what we have proved is that everything balances. And that is the first step. This is why I'm saying management accounts are flawlessly reliable, because they pick up everything. And they make sure everything is picked up. There's no room for something to fall down. If you just produced a P&L without a balance sheet, you could have any number you like down here as your profit. Any number of mistakes could be made up here. It wouldn't matter what I said down here, because there's nothing to compare it to. There's nothing to prove that it balances. So let's look at the P&L, or profit and loss, also known as the income statement, in a bit more detail. So this is the same P&L we just looked at. And it's important to recognize what the three statements represent. So the P&L relates to activity in the period. So this period is January 2021. You could also have a year to date for 2021. So if this was, let's say we're in June and you're looking at a year to date, then that would be the period of January to June 2021. You could actually run a P&L from when you first started your business up to now, and that would be a period. I mean, nobody does that, but you could. So the important thing, though, to recognize is that all individual transactions are captured in the P&L. So if you sell something in January, it's in here. If you sold something in December, it's not in here. This is just so that you can look at the activity in the month and see if it compares to what you thought you would do. So let's look at the balance sheet, also known as the statement of financial position. Balance sheet shows the position as at the end of the period. So whereas the P&L shows the activity in the period, the profit made in the period, the balance sheet shows the balances of all the individual transactions as at the end of the period. So everything in your P&L is an individual transaction in that period. So for example, your profit for the current period is in here, as we looked at in the previous slide. But your profit, the profit your business has ever made is here. So that's what I mean by that. You won't see that 35 grand in your P&L because it relates to previous periods. The total, so in February, whatever profit you make in February will be added to the 16,543, but the retained earnings from previous years will remain the same because that's set in stone now. So that's your balance sheet. The cash flow statement shows how cash has been utilized during the period and also the balance at the end of the period. As we've already seen, this 42,887 appears in your balance sheet. So that's the balance as at the end of the period, but the movements during the period are in here. So you've got an opening balance here. That's the important point, is that the only way you can get to this is because you've got this. Cash movement is 2298. So the sales receipts in of 196 minus the payments out 176 is 2298. So all management accounts are not equal. As I said earlier, I've had no end of management accounts put in front of me. They're not management accounts. Management accounts are specifically prepared in accordance with the accounting concepts we've looked at, and they use comparative reporting. Anything that doesn't include those things, and anything that doesn't have a balance sheet and a cash flow statement, are not management accounts. So, for example, here's a P&L. It's just a list of P&Ls. So, as I said earlier, there's nothing to anchor this. There's nothing there. There's nothing to prove that these profit figures are correct. And there's no comparatives. What I mean by comparatives, we'll get into that shortly. But what I really mean is there's nothing to compare it to. You know, we did 25 grand worth of sales in January, but what did we expect to do in January? What did we do in January the previous year? None of that's in there. So you don't know how well or badly you've done. Bear in mind what I said before. It's not how have we done. When you talk about performance valuation, it's how are we doing? And you can't know how you're doing unless you've got something to grade it against. This is another set of management accounts. Now, this one, to be fair, does have comparatives in it, but look how detailed it is. It's too busy. You know, you might as well, if you're going to do that, you just run a trial balance. And if you look at the detail in more detail, you've got things like, you know, direct labor, van driver, fitters, etc. You could lump all that together as direct labor. The point of management accounts is to get a snapshot of how you're doing. You know, the detail, the investigation and detailed analysis is done in the reporting after you've produced your management accounts. So you could just put packaging instead of boxes, tape, bubble wrap and banding. In here, all of these could be lumped together. So water, gas, electricity, TV license, premises expenses, car insurance, van insurance, public liability insurance, employer's liability insurance is just insurance, and so on. So you could massively trim this down and make it a far more relevant and meaningful report. And then this one is too broad. Revenue, cost of sales, gross profit. I mean, this is fine as a headline. If you could have this at the top of your management accounts and then have all the detail below it. But really, what's the point? So, comparative reporting. I keep talking about it. Now we're going to get into it. Budgeting is the most important thing you can do in your business. I'm not saying it's more important than performance evaluation because it's part of your performance evaluation, but it's vital. You cannot produce a set of management accounts. As I've said earlier, if it doesn't have comparative reporting, it is not management accounts. They are not management accounts, I should say. And without a budget, there's no comparative. There's generally two comparatives you need in your business, your budget and your prior year. And your budget is far and away the most important of those two. In the early years of a business, the prior year isn't as important because that's when a business experiences a lot of volatility, hopefully a lot of growth. And looking at where you were this time last year, it can make you feel good or it can make you feel shit, but it's not overly important at that stage. But what it does do is give you a trend. So once you've been in business 3 years, if you've got data from year 1, year 2, year 3, you can use that to predict trends. You can use it for forecasting. So it's important to capture the data in years 1, 2, and 3, but it's not that important to grade yourself against it until later on, maybe years 4, 5, up to about 10, not onwards. But your budget is the most important comparative of all. So I'm not going to bang on about that particular budget. What we're going to do is look at how your budget helps. So if you imagine this is your profit and loss, it's the exact same P&L that we looked at earlier. I'm going to show you how important comparative reporting is. So that really tells you what? It tells you you've done 16 grand worth of profit. It tells you you've done 267 grand worth of sales. And it tells you your gross profit and gross margin. Brilliant. That is important stuff to know. And even that in itself is a form of performance valuation. But it's no good to you, really. What you really need is comparatives. So you bring in a budget. Now, this immediately gives you far more functionality and meaningful reporting. So we did 267 grand worth of sales. Well, that's great because we hope to do 265. So we're actually 2 grand up. And that's the theme across this particular example. If you look at all of these, 27,233, budgeted 27. But the important point, I mean, this is a simple example. The important point is this column here, variances. The green variances are positive, the red variances are negative. You don't want to be seeing a lot of red on this side, but if it's 233 quid or 100 quid or 120 quid, who cares? You know, and at the end of the day, your gross profit, you budgeted 158 and you did 161, so you're 3 grand up. So that's the key thing. You want to look here, look here, look here, and look here. Look at the important figures and see where you're at. So then the other comparative, as I said, is the prior year. So in this case, as I said earlier, it's not really that big a deal in the early days, because you will be growing, hopefully. So big increase on the previous year, 88,000, nearly 90,000 up on the previous year. That's a big increase. But it could just be because the business is on an upward trajectory and it's growing fast. But all this red down here doesn't look great. It's pretty horrible to look at. But all it means is, again, it's a growth. It's a sign of growth. So you're up 27,000. Previous year, you spent 19,000 on direct labor. This year, you've done 27,000 on direct labor. But you've got 88,000 pounds worth of sales more, and you budgeted for what, 80,000 more. So that's fine. This is not something to worry about. If this was all reds and big reds, then yeah, you'd be concerned. But if you look at these percentages, 10.2%, 10.7%, 20, 21, 2.83, that's in line. So what I'm saying is the costs have only grown in line with the way the sales have grown. So there's nothing to be too concerned about there. But variance analysis is vital for decision-making and assessing your economic viability. So this is a bit of a sneak peek into the second part of this part. We are talking about performance valuation, but of course, performance valuation informs your economic viability. So we've looked at performance valuation. Management accounts is what we're talking about. If you have the three statements that must be in management accounts, use the accounting concepts we talked about, and you have comparatives in your P&L, then that's performance evaluation. It's not how have we done, it's how are we doing. You can't know how you're doing unless you compare it against something, which is where the comparatives come in. So to assess your economic viability, first, like we said, you need to do your performance valuation, which is how are we doing compared to our comparatives. Are we doing better than last year? And are we doing well compared to our budget? How are we doing? That's your performance valuation. So economic viability, as we said in part one, is it good enough? And is it sustainable? I don't mean environmentally sustainable, which is obviously a good thing if it is. But what I mean is it good enough now? And will we be able to sustain that long term? So how are we doing? The question, I keep reiterating this, but the question is not how have we done or how we're going to do, it's how are we doing? Management accounts give you that because of the budget. Is it good enough? This is the key question. So the way we determine whether it's good enough is using the management accounts data as a starting point. The management accounts don't actually tell you if it's good enough, because if your budget is, you might be doing what your budget said. If your budget over several years helps you to hit a 3-year plan or a 5-year goal, then that's good enough. So that's really what we're talking about. You produce your management accounts and then you decide whether it's good enough. So to do that, we use break-even analysis, but that only tells you if it's good enough in the current period. Break-even analysis means how much profit do we need to make in order to cover our fixed costs? And then from there, how much do we need to do in terms of sales to make that much profit? So ultimately, you arrive at a sales figure that will cover your costs if you achieve the margin you expect it to. So let's look at that in more detail. Break-even sales is found by dividing your total overhead costs or fixed costs by your gross margin percentage. So in this case, 145,125 divided by 60.5%, which is your gross margin percentage. If you do that, you should come out at 239,876, which is the sales you need to achieve in order to break even. And that's based on your 60.5% margin. If your margin reduces or increases, then your break-even sales will increase or reduce as well. You can obviously try that out with different scenarios. You can use that to simulate different levels of activity. So if you know your sales are only going to be 220,000, then you need to reduce your overheads. You need to reduce your fixed costs. There's no point in reducing your cost of sales because that will impact your margin and will therefore change your break-even point. So if your fixed costs are 145 grand and you know that if you if your sales drop below 238,000, you're not going to be able to cover your overheads. Then you need to either make sure you're always ahead of 238,000, or improve your gross profit margin, or reduce your overheads in order to make profit, or in order to improve profit. And this is what I'm talking about. This is where performance evaluation and economic viability come together to give you total control. If you've done an accurate budget and you're on target, you know whether you can improve your margins or reduce your overheads, or whatever you need to do in order to get to the number at the bottom of this table that tells you what you want to hit. Management accounts are a diagnostic tool. They can identify symptoms, but deeper analysis is required to resolve those problems or understand victories. To understand whether performance is good enough in the long term, though, because this, bear in mind what we just looked at tells you, right, performance is good enough today or this month, right? So you know from your budget, we need to do X amount this month to break even, and you've done it. So that is good enough. You know what the benchmark is. But to look at sustainability, you need to go a bit deeper. So that's the next question. Is it sustainable? Sustainability is one of the biggest challenges faced by business, and there's various factors to consider. You've got market factors, size, competition, and products. You've got supply chain. You know, the fuel prices and so on in recent years have gone through the roof. Supply chain can be disrupted, and that will hinder your ability to make sales. Changes in technology. You know, you could become completely obsolete overnight if there's technological advances, or the way you deliver things could be disrupted if there's changes in technologies. Changes in legislation and regulation. We look at Brexit. You know, I mean, that's had a massive impact on loads of different industries, because, you know, a lot of industries in this country import things or export things. Budgetary constraints. You know what I mean? If you don't have enough money to invest in your business, then you've got to look to the future. If your year 2 budget is based on you investing a certain amount of money, and in year 1 you don't make enough money to do that, then that will affect your sustainability. Resiliency, you know, if there's a cyber attack, it could take you out. If you're an e-commerce seller and Amazon goes down, could knock your business on the head immediately. You know, there's certain things, again, in e-commerce, if you don't abide by Amazon's rules, they can lock your account like that. And then suddenly you've got no money coming in, and you've got wages to pay. Unforeseen events, obviously that's a major, look at, you know, the one that everybody uses at the moment, COVID. You know, not necessarily unforeseen. Some people saw a pandemic coming. They might not have known it was going to be called COVID, but some people did see a pandemic coming, and they were prepared for it more so than others. So unforeseen events is another thing that can disrupt it. Truth is, anything can hit you and you know, damage your business and disrupt your sustainability. So the best way to get around, though, again, because there's anything could hit you, and we'll go into this in more detail in part 3 of this course, but the braking distance principle, don't get caught out. You know, the braking distance principle is something that I've come up with for my courses, which, I mean, I didn't come up with braking distance. Obviously, that's part of the highway code. But in a business sense, it's similar. If you're in the UK anyway, and in most countries, if you drive into the back of somebody, it's your fault. Very, very few exceptions to that. If you drive into the back of somebody else in your car, you're at fault because you didn't leave enough braking distance. You should have left more space so you could brake. If the road's wet, your fault. If the person in front braked suddenly, your fault. You know, you're supposed to leave enough distance. And it's the same thing in business. If you leave enough distance, i.e. you think far enough ahead and you take accountability, you won't get caught out. And the best strategic position is always, how are we insufficient? I mean, this is across the board. It's not just even in business. How are we insufficient, and what can we do to rectify it? So the 4 points of control. This is how we establish control. This is how we create performance evaluation, make sure our numbers are correct, and then we use the work generated from establishing control to assess our economic viability. So the 4 points of control, we touched on it in part 1. We're going to get into it in more detail now. So there's our logo, which, as I said in part 1, represents the 4 points of control because it is literally intrinsically built into our business and everything we do. But this is the actual layout that we use for the 4 points of control, so, which are cash and ledgers, assets, liabilities, reporting, and external factors. the way they all fit together into the three elements of control is we're going to go through that now. So there's a concept that we use called the transaction flow, which we're going to look at in a moment. Every transaction that comes through your business flows through your business. Initially, it needs to be captured, then it needs to be balanced, then it needs to be analyzed, and then it needs to be evaluated. So every transaction that comes in has to be picked up in a certain way and dealt with in a certain way in order to make sure it's A, dealt with correctly, and B, gives you the data that you need to get control of the business. So how does that translate into the three elements of control that we've been looking at all the way along? Well, performance evaluation, as we've already looked at, is your management accounts. So points 1 and 2 basically create the performance evaluation that we want to achieve. Points 3 and 4 cover economic viability and compliance. So this is how it all pulls together. So if you get the 4 points of control in place and you work around that framework, you will achieve performance evaluation and from there achieve economic viability and compliance. So the transaction flow we just talked about. Point 1, the transaction is captured either in the cash book or the ledgers. Point 2, the transactions we've captured in point 1 are balanced. Point 3, the balanced transactions are analysed. And point 4, after analysis, the transactions are evaluated in the context of the external environment. So put simply, the management accounts are created from points 1 and 2, and the management accounts form the basis of points 3 and 4. So cash and ledgers, what are they? What are they all about? So it's about capturing transactions. Everything that comes in, every transaction that comes into and out of your business goes through a cash book or a ledger. This captures individual transactions. When we talk about cash, we don't just mean, actual physical paper and coins. We're talking about cash, PayPal, anything like that, any kind of electronic payment system, like, even cryptocurrency now. PayPal, you got checks, which I know hardly anybody uses anymore. Even things like gift cards, gift vouchers, they can be used as transactions. If you're in the retail industry, you probably do quite a lot of transacting with gift vouchers. And of course, you've got credit and debit cards. All of these come under the bracket of cash and other things besides, but these are the most common examples. So that's when there's a cash transaction, as in I come into a shop, I give you some money, you give me a product, job done. But obviously in business, there's a lot of credit transactions. So cash is paid and received, and it's a settlement of an asset or liability there and then. Ledgers are payable and receivable. So it's not paid and received, it's payable and receivable. And it's the recognition of an asset or liability. As opposed to settlement of an asset or liability, it's recognition. So I know that's not necessarily a concept you come up against all the time. So we're going to go into a bit more detail. So let's look at some examples. So cash sale example, we're selling a pair of shoes. There's your sales account. If you remember back in part 1, we talked about a chart of accounts. In your chart of accounts, you've got a sales account. So again, for every debit, there's a credit. So the debit side receives value, the credit side gives value. So you've got a sales account for selling this pair of shoes. You've got a bank account for receiving the money from selling this pair of shoes. So we've sold these shoes for 200 quid. They're really nice shoes. So you credit your sales account £200. You've received some cash, which you bank, or maybe they paid it straight into your bank with bank transfer. So you've received 200 quid in there. So debit, credit. The accounting equation and double entry accounting are satisfied, everybody's happy. So that's a cash example. But what if we sold these shoes on credit? Let's look at that. So credit sale example. So we've still got a sales account, but we've now got, instead of the bank account, we've got a debtor's ledger because there's no cash coming in as a result of this transaction, at least not straight away. But we need to recognize the sale straight away, even though we're not receiving the money. So that's exactly the same. You credit the shoe sales account by 200 quid. But this time you debit the debtor's ledger with 200 quid. So you've recognized the sale and you've recognized the asset. So somebody owes you 200 quid. So then let's say 30 days credit we've given on these shoes. So 30 days later, you get some money into your bank account. So you debit 200 quid into your bank account, but you need to credit something, because for every debit, there must be a credit. So you credit the debtor's ledger account. Because if you credited your sales account at this point, you were doubling the sales. If you credited the sales account 200 quid, that would be 400 pounds, which means you've recognized those shoes as a 400 pound sale when you only actually sold 200 pounds. So you can't credit the bank account because you haven't paid any money out of your bank. So you have to credit the debtor's ledger. And this is literally the point of a ledger, is to manage delays between the recognition of an asset or liability and the settlement of an asset or liability. So they're actually widely used in business, and they're often known as control accounts as well, because it's not just sales, obviously, where there's a delay, anything where there's a delay. So other common examples of ledgers and control accounts would be obviously the one we just looked at, and obviously the opposite, which is the credit. So that's where you've had credit from a supplier. Your VAT control account. So if you're VAT registered, you will be collecting VAT from your customers and paying VAT to your suppliers. But the difference between what you collect and what you pay out, you have to pay over to HMRC at some point, but you don't do it instantly. You collect the VAT from your customers and you pay the VAT to your suppliers. But at the end of a quarter or a month, or annually in some cases, you would then tot up how much money you've paid to your suppliers and how much you've collected from your customers and pay the difference over to HMRC. But you owe that money to HMRC the minute you collect it. You can't just wait until you've got to pay it over and then work it out. You have to recognize that liability. So the liability arises as soon as you raise the invoice to your customer, but you don't pay it over until potentially 3 months later or 12 months later. So you have to recognize it by putting it in a control account. Again, there's a delay between the recognition of the liability and the settling of the liability. Pensions, you deduct pension contributions from your employees. So that money is owed to the pension, it's owed to your employees, but it's owed via a pension company or a pension scheme. So you recognize the liability. When you run your payroll, if payday is the 25th, you might run your payroll on the 20th, but they don't take the pension contribution out of your bank account until a month later, potentially. But you have to recognize that obligation and then you settle that obligation. So again, you need a control account for it. Same thing with wages. You run your payroll on the 20th, but you don't pay your employees until the 28th. So it's only 8 days, but you have a liability that you need to recognize, and then you settle that liability on the 28th. PAYE, the same principle. I won't go through it all again. It's the same thing as the VAT and the pension and the wages. Now, there could be no end of control accounts. In a big business where you've got all kinds of different things being offset and delayed, there could be all manner of control accounts in the chart of accounts, but these are the most common. So cash and ledgers, as I've said, capture individual transactions and create cumulative balances known as assets and liabilities. So that's the second point of control, assets and liabilities, balancing. So in the transaction flow, we are now onto the balancing stage. So after capturing the individual transactions in point one, the next step is to collate them and make sure everything adds up. The transactions for the period, remember, appear in the P&L. Balances of the accumulated transactions appear in the balance sheet. So this is the balance sheet we looked at earlier, and you'll see what I'm talking about here. So there's your accounts receivable, your banking cash equivalents, and your prepayments. So accounts receivable is money you're owed. It's effectively your debtor's ledger, debtor's control account. It has different names, but that's what they mean. Accounts payable is the opposite. You pay that money out to your creditors. So here you can see in the balance sheet, all your control accounts have balances and they are reconciled and held, if you like, on the balance sheet. So the third point of control is reporting. At this point, we've created our management accounts. We've got our budget in place. We've got our comparatives, and we've created management accounts in accordance with the accounting concepts we learned in part one of the course. So the next step is reporting. Now, reporting from a financial point of view basically means how and why. How and why have we achieved that? It's not a case anymore of what have we achieved, because that's covered in the management accounts. This is now a case of how have we achieved that and why have we achieved that. So how and why did we achieve what we achieved? That is the entire purpose of financial analysis. Failure and success. This is I can't stress this enough. Failure is always analysed because people want to know what went wrong. But success is often left alone, left to its own devices, because people are like, okay, well, great. What's to learn from that? Well, there's lots to learn from that. So you should analyse both where appropriate. Now, a massive part of your reporting, once you've finished your management accounts, is your variance analysis. This is really where it all comes together. This is where you will start making a difference and getting control of things. So we're going to look at a couple of examples. This is the same P&L that we looked at when we first looked at performance valuation. It's exactly the same, this one, identical. So sales and costs are both comparable with budget in this example. So there's no variances at all. There are variances, but there's a degree of materiality here. You know, do we care that, you know, 27 grand was actually 27,233? No, we don't. And that's not a matter of opinion. You shouldn't give a shit. If you've done £233 worse than you thought, well, if your budget was 500 quid and you've gone over it by 233 quid, then yes, that's cause for concern. But these percentages here, 10.2, 10.2, 20, 20.8, 2.8, 2.8, 1.4, 1.5, these are not the sort of things we should be worrying about. These percentages, by the way, are a percentage of sales, because sales drives everything. When it comes to budgeting, your sales budget is your starting point. When I say sales drives everything, don't misunderstand me. I'm not saying sales is the most important number in your business. I'm not saying turnover is more important than profit or anything like that. What I am saying is that your sales output, you shouldn't really call it sales, output is a better word. Your output generates cost or creates cost. You incur cost in order to generate output. That's why these percentages all the way through the management accounts are a percentage of sales, because the ultimate activity of any business is output. You do something, whatever it is that business does is the output, and that is what generates the revenue to create profit to cover overheads. So let's look at example 2. So in this case, there's a 40% increase in revenue. However, despite the big green number here, so we budgeted to do 265, we've actually done 374. Despite this big variance here and these big variances here, there is no actual variance, no variances. What do I mean by that? There's no variances because things have only increased, costs have only increased in line with the sales increase. So sales is up by 40%, the cost of sales is up by 40%. Now bear in mind here, we're not looking at overheads. Overheads are a fixed cost. They should be the same no matter what. If you've budgeted 30 grand for rent, then rent should be 30 grand. Even if you triple your turnover, there should be no impact on your overheads, only your cost of sales. So if cost of sales increase, but they still stay the same here, if you look at these massive variances, over £40,000 worth of negative variances there, nothing to worry about because the percentages are the same. So as sales has gone up 40%, costs have gone up 40%, nothing to worry about. Not even, and I know I said earlier about looking at things when they've gone well. Obviously, you should look at why your turnover has shot up by 40%. That definitely needs to be looked at because it could be an error. It could be that the sales you expected to achieve in February have for some reason happened in January, and you need to brace yourself for the fact that sales are going to drop off worse in February. Or it might mean that you need to build more infrastructure into your business to cope with these increased sales. There's several lessons to be learned, so don't get complacent about the fact that your sales have shot up by 40%. That definitely needs to be analysed. But what I mean is there's no analysis to be done on your costs, on your variable costs, because they're all behaving in the way you would want them to. If sales have gone up 40% and the cost of sales has gone up 40%, there is nothing to worry about from a cost point of view. And again, if you look at the bottom there, your gross profit margin is the same. You budgeted 59.6 and you've done 60.5. So, all right, it's slightly up. It's like 1% up, but it's nothing to be concerned about or to look at. It just illustrates that everything's where it should be. So let's look at example 3. 40% increase in revenue. So it's exactly the same from a revenue point of view. We expected to do 265, we've done 374, 108,000 up. However, there is variance analysis required on this one. The reason I'm saying that is, I mean, on balance, there's a 40% increase in sales and a 40% increase in roughly in variable costs. However, we've got some compensating variances. We know they're compensating because, again, the gross profit margin is unaffected. It's roughly where it should be. 59.6 budgeted, 60% achieved. So that's pretty much where we want it to be. However, look at these variances here. 10.2% we budgeted for direct labour. We're actually achieving 3.4%, which is amazing if it's true. But then look at fuel. We expected 20.8%. It's shot to 27.4% of sales. So again, could be a big deal that, because what the risk is that next month, we don't know why direct labour is so low this month. We need to find that out because if direct labour returns to budgeted levels next month and fuel stays where it is, this won't be quite such a good news story. We'll be way up on fuel and back in line on direct labour. So analysis is definitely required at this point. And this goes back to what I said earlier. The management accounts are a diagnostic tool. They won't tell you why direct labour is up or down. You need to do some labour analysis. They won't tell you why fuel is up or down. Could be that there's a fuel shortage, or it could be that there's the price of Brent crude oil has shot up through the roof, and that's led to an increase at the pumps. There's all kinds of things that could be causing that. So this is why you need supporting reports. So when you find a problem in your management accounts, you need to be able to refer to some reports that tell you what has caused that problem. And this isn't something you should only do when you find a problem. These reports should be prepared every month, because what they'll do is make you aware that there might, like if you know that the fuel price has been shooting up, then these reports will tell you that and you'll be ready for it. So rather than waiting until, sometimes the management accounts will highlight something to you that you were completely unaware of and couldn't have been aware of. But sometimes if you do supporting reports regularly, every month or every week, even in some cases, you'll get visibility that will help you to avoid nasty surprises. So things like sales reports, labour analysis, stock usage, shipping reports. These are all just random examples. It's obviously got to be whatever's relevant to your business, but it's vital, whatever you do, that they correlate with management accounts. If your sales revenue in your management accounts is 300 grand and your sales report says 276, then your sales report must be wrong in some way, because it's, your management accounts, as we've already talked about, if they're being done properly, which is the key point, they need to be done properly. But if you follow the 4 points of control, they will be done properly. And what you'll end up with is flawlessly reliable management accounts. And anything that disagrees with those accounts has to be wrong. The most likely reason they're wrong is because other reports don't have to adhere to the accounting concepts we've looked at. So that's one of the reasons they could be wrong. Well, the last of the 4 points of controls is external factors. Now we're going to look at these in a lot of detail in the third part of this course. So we're only going to skim over it for now. So your external factors could come from anywhere, but the best place to start, and the most, this will be applied to all businesses, is your economic environment. The market in which you operate, the customer behaviors and the forces around them, the things that force your customers to behave in a certain way. External regulation, obviously everybody's got regulation, and external events. So this list, as it says there, is not exhaustive, but these elements are common to all businesses. Now, I'm not going to do any more on external factors in this part of the course, because there's a lot of that in part 3. But what I do want to touch on is, I said to you earlier that the management accounts and the comparative reporting and being prepared in accordance with accounting concepts proves the numbers in the management accounts. But you need to have supporting mechanisms and supporting reports that make sure the individual numbers are correct as well. So this is what we call control mechanisms. The other benefit of control mechanisms is that they give you a degree. They tell you to what degree you have control. So effectively, we are measuring degrees of control. So each of the 4 points of control has a control mechanism. So as we've said earlier, the elements, the first 2 points of control is what creates your management accounts. The second 2 points of control are driven by management accounts. So the control mechanism that makes sure you get accurate management accounts, reconciliations, that applies to your P&L. Every number on your P&L needs to be reconciled to independent documentation. Every number on your balance sheet, all your assets and liabilities need to be reconciled to schedules. So reporting is the control mechanism is relevancy, impartiality, and accuracy. So all reporting should be relevant and impartial and accurate. Otherwise, what's the point in it? There's no point looking at irrelevant information. There's no point looking at inaccurate information. And there's no point having information that has an agenda behind it, because it will influence things in a certain way. And you don't want that. You want people to be able to interpret the reports in multiple ways, so you can have a reasoned and multivariate discussion about it. And external factors comes down to weighted sensitivity metrics, which we'll go into in a lot more detail in part 3. So let's have a look at reconciliations, which is the control mechanism for point 1, cash and ledgers. So the key point is they're reconciliations between independent data. So we've got here a statement of account from the supplier. So it's external, it's independent because it's an external third party. The extract from our own purchase ledger is there. So that shows 3 invoices. You can check the invoice numbers against the statement from the supplier. You can check the account balance, 5,400. So this is the reconciliation in point 1. We're reconciling to a ledger. So the purchase ledger, which is also known as the creditors control account or the bought ledger. You know, these things have multiple names, but they're all the same thing. So we're reconciling that to an external independent document. Same thing here from a cash point of view. So that is your bank statement. It's from your bank, it's independent, it cannot be fudged or tweaked. It's an external independent document. This is an extract from your cash book. Every single transaction on your cash book reconciles back to every single transaction on your bank statement. And if you look at the balance on the last day, 13th of January, 1375.85, 13th of January, 1375.85. So we're happy that those both agree. So that is the control mechanism for the first point of control, which is cash and ledgers. Independent data is the key. So for the second point of control, balancing assets and liabilities, the control mechanism is balance schedules. So here's your balance sheet, which is the record of all the balances, all the assets and liabilities that you've captured. Let's look at this in more detail. So this is a schedule of all your cash balances. Now this is an internal document, so you can't count this as your independent data. And this is your balance from your creditors control account, which includes all your suppliers that you currently owe money to. And again, this is internal. You can't class this as reconciliation to independent data. However, what you can say is that the 42,887 cash balance agrees to the balance sheet, where the 42,887 is the cash balance. 18,542 is your creditors control account balance, and that agrees to the balance sheet. Now, at this stage, we could have fudged all of this, all of these numbers here, and all these numbers here. Anybody who's, you know, corrupt or lazy or doesn't want to do their job properly could quite easily have just shoved all those numbers in. However, bear in mind what we said earlier, right? That this 52,387 and the 52,387 here and the 16,543 is the profit from your P&L, if you remember. So what we're saying is, though, if these numbers were anything else, then this would not agree with this and the accounting equation would fail. So what we're talking about is making sure that all these numbers are correct. So this doesn't do that, because this is not independent data. This is our own data, which we could have forced. So we need to go one step further. So what we're going to do is pull up from earlier. If you remember, we used the bank statement and the supplier statement, which are independent data. So what we're saying is, there's your 13,785 and there's your 5,400. So what we're saying is, each one of these numbers has been reconciled to independent data, and each one of these numbers has been reconciled to independent data where possible. So that means that these numbers, by definition, because they're the total of these numbers have been reconciled to independent data. So we can now go back to here and we can say, right, these numbers have to be correct because we've reconciled them independently to external data. So the last control mechanism we're going to look at in this part of the course is reporting, which is, as I said earlier, relevancy, impartiality, and accuracy. So relevancy, there's no point in reporting data if it's irrelevant. You're wasting everybody's time. Impartiality, they need to be fact-based and free from bias, open to interpretation from different perspectives. Because the whole point of these reports is to present them and say, there's the data, not there's the data and that's what it means. There's the data and that's what it means. It's got to be, here's some data. Let's review it. Let's all bring our independent interpretations of this data to the table and have a conversation. And of course, it has to be accurate. I mean, I don't even really need to explain why that is, but what I mean in this sense is they should all reconcile or balance to supporting data. It can't be accurate just because the guy that created it says it's accurate. He needs to produce, or she needs to produce, something that says, well, here's the supporting reports behind it. Here's the supporting data. I've run it from the system. Here's the information that backs up this report. You might not need to present that because it might be obvious that it's accurate, but it needs to be there if needed. So that's it for part 2 of the course. So this part of the course was all about the performance valuation and economic viability elements. So economic viability will feed into the third part of the course, because obviously performance valuation we've covered, that is based on the data we have. Economic viability, there's 2 stages to it. One is it good enough now? And the other is it sustainable into the future? We can't know that at this point, and that's why it bridges parts 2 and 3, because the external factors we're going to look at in part 3 will also have an impact on your future economic viability. So we've pretty much covered performance valuation at this point, but we've still got more to do on economic viability, which we are going to do in the next part of the course alongside external factors. So thank you. I hope you enjoyed this, and I hope you enjoy the third and final part of the course. If you have any questions, like I said at the end of part 1, drop us an email, get in touch on social media. You can go on the website and book a call with somebody from PPX, and we will talk through your specific requirements, make recommendations. We don't do hard sell. You won't be getting phone calls weeks later bugging you about buying something. We don't work like that. But if you want to know more about anything you've seen on this course, either give us a call or set up a call on the website, or just drop us an email. We are here to support SMEs, and we'll do anything we can to help you.